Well, good afternoon, everyone. My name is Jack Sun, and on behalf of the CFA Society San Francisco and its member Programming Advisory Council, it is my pleasure to welcome you all to our event today, the U.S. and China Economic Conflict, Implications for Investors and the Business Community, with our panel of experts with decades of experience in research, policy, and law. Now, before we start, a quick note, you will be muted for the event, so we encourage everyone to type the questions in our Q&A box below. We also monitor the questions closely and try to answer them as many as possible over the next hour. Also, this event will be recorded, so we'll share the replay afterwards as well. Now, I'd like to turn it over to my moderator for today, Nicholas Borst, Vice President and Director of China Research at Seafarer Capital Partners. Prior to joining Seafarer in 2018, Nicholas was a senior analyst at the Federal Reserve Bank of San Francisco, covering financial and economic developments in Greater China. Previously, he was the China Program Manager and a Research Associate at the Peterson Institute for International Economics. Nicholas also worked as an analyst at the World Bank. His research and commentary has been featured in the Financial Times, the Wall Street Journal, the Economist, Bloomberg, and South China Morning Post. Nicholas is a 2021 to 2023 Public Intellectuals Program Fellow at the National Committee on China-U.S. Relations and has testified before the U.S. China Economics and Security Review Commission on multiple occasions. So, Nick, I'm going to turn over to you so you can introduce our speakers for the day.
Well, thank you for that introduction, Jack, and thank you to the CFA Society of San Francisco and the National Committee on U.S. China Relations for helping us pull together this event. China represents an unprecedented challenge for American investors. The US and China are the world's two largest economies, and they're also the world's two largest capital markets. Over the past several decades, the US and China have built a very large and interconnected investment relationship. Americans helped advise China as it was first creating its capital markets in the 1990s. US investors were key early investors in some of China's most important private companies, and American financial institutions helped hundreds of Chinese companies list on foreign exchanges. Over the years, US investors have put hundreds of billions of dollars to work in China's bond and equity markets. Yet this significant investment relationship is in danger of unraveling, and that's really due to the strains in the political relationship. Many observers think that the US-China political relationship is the worst it's been in more than 50 years. Over the past 5 years, we've seen Washington implement sanctions, tariffs, export controls, and outright investment bans targeting China. In turn, China has forced many of its companies to turn inwards and has subjected them to increasingly onerous national security controls. Earlier this year, in the case of Russia, we really saw what a hard financial decoupling looks like. Driven by US sanctions and the reaction of financial institutions to those sanctions, Russia was essentially deleted from the investment universe in a matter of a few short days. And while neither Beijing or Washington is talking about that type of hard financial decoupling, both have taken steps towards a soft decoupling in recent years. So it's really more important than ever for investors to have an understanding of the US-China economic relationship. That means understanding what actions have taken place so far, what may be coming in the future, what impact on investment flows the current policy environment is having, and how companies, both Chinese and American, are reacting to these challenges. So I'm really thrilled that we have such a great panel here today to discuss these issues that help us make sense of all this complexity. I'll start by introducing Anna Ashton. She's the Director of China Corporate Affairs and US China with the Eurasia Group. In this role, she examines business implications of policy developments in China and US policy towards China. Previously, she was a fellow at the Asia Society Policy Institute and Vice President of Government Affairs for the US China Business Council. Next, we have Nelson Dong. Nelson is the chair of the National Security Law Practice and co-chair of the Asia Pacific Practice at Dorsey and Whitney. Nelson advises companies on domestic and international technology licensing, outsourcing, manufacturing in Asia, and US export controls. Previously, Nelson was an assistant U.S. attorney in Boston, deputy associate attorney general at the Department of Justice, and a White House fellow. Last but not least, we have Thilo Hanneman. Thilo is a partner at the Rhodium Group, where he leads the firm's work on global trade and investment. He's also senior policy fellow at the Mercator Institute for China Studies, which is one of the premier think tanks in Europe focusing on China. Prior to joining Rhodium, Thilo worked in academia, the public sector in Europe, China, and the United States. So we have a great group of panelists to talk about the U.S. China economic relationship today. Just a note on programming, as Jack mentioned, we're going to have about 30 minutes of discussion on the panel and then open it up to Q&A. So as you do have questions, please submit them to the chat, and then we'll try to get to as many as we can. Nelson, I'd love to first start with you. During your career, both inside of government and outside of government, you've been a very keen observer of the legal and policy changes emanating from Washington that are impacting the U.S.-China economic relationship. So I'm wondering if you could help us make sense of what have the major changes been over the past 5 years, which policies are having the most impact, which ones may be having unintended consequences, and overall, what are both the continuities and the changes you see between the policies unveiled by the Trump administration and those under the Biden administration?
Thanks, Nick. To respond to your opening questions, let's try to unpack modern international commerce and think of it as consisting at least of 3 basic flows, all of which are then subject to modulation and interruption by legal barriers. There's the flow of people, there's the flow of technologies, and the flow of goods. And so I'll go through all of these. There's a 4th interrelated flow, the flow of funds, which I know that Anna and Thilo will cover. These are really equally important, just like the Treasury Department's new non-specially designated national Chinese military industrial complex companies list, which is such a mouthful. That's administered by the Office of Foreign Assets Control, which is the sanctions body in the U.S. government. They in turn rely heavily on the Department of Defense to identify which Chinese companies ought to go on that list. And we just saw in the past week that the Pentagon released some new names for its so-called Section 1260H list, which included the largest drone maker in the world, DJI, and also BGI, the huge global genomics company. So those kinds of barriers also exist. But let's turn back, to those 3 flows that I wanted to talk about. In the terms of the flow of people, if you flash back a little bit to 1978 and Deng Xiaoping's speech, where he talked about the great opening to the West, in June of '78, Deng gave a remarkable speech in which he advocated that Chinese university students should go abroad to study. And since Mao had only died in 1976, and the Cultural Revolution had closed down Chinese universities for multiple years, starting in 1966, that was a pretty bold statement. Now, in 1979, right after that speech, there were roughly 2,000 Chinese students in American colleges and universities total. Fast forward 43 years to the 2021-22 academic year, the survey agencies really now count roughly 317,000 Chinese students studying in American colleges and universities. So that's a massive growth over that period of time. And in fact, if you look at the survey data, the 317,000 Chinese students in American universities today constitute 35% of all international students studying in American colleges. So this is a huge shift over the past 4 decades. However, there are some troubling signs that policy changes are affecting that flow. In the first 6 months of 2022, F1 student visas from China fell roughly to 50% of the level that Chinese students were using visas in the pre-pandemic era. So if you really look at technology hubs like Silicon Valley, where you are Greater Boston, my own community of Seattle, the New York area, Research Triangle Park, pick any technology hub in the country, and you'll find a huge swarm of immigrant scientists and engineers and other technologists from around the world, but especially from China. So if this blip that's developed in the flow of Chinese students into American colleges and universities were to continue on multiple years, that could spell a real troubling signal for American economic competitiveness in the coming years. So my takeaway message on the flow of people is that US immigration laws are something that people need to monitor and keep an eye on. US immigration policies can really inflect the stock of human capital and particularly in the STEM fields that are going to be so vital for economic competitiveness in the 21st century. Turning to the flow of technologies, if you look back at the development of American industry and commerce since World War II, many of the major discoveries in microelectronics, in biotechnology, and so forth have all come out of university research labs driven by enormous amounts of money from the NIH and the NSF and other federal funding agencies, DARPA from the Defense Department and so on. And this has all been part of the substrate that's created the economic success that the US has enjoyed since that time. At the same time, the United States, looking at the experience before World War II of how the world's commercial activities almost ceased as countries raised tariff barriers, and including our own Smoot-Hawley tariffs in the 1930s, their wisdom to the world was, let's trade, let's lower tariff barriers gradually and increase the flow of export from all over the world, both of raw materials and of manufactured goods. And so that has led to the globalization phenomenon we have now. But in both realms, both on the import side and on the export side, we have begun to shift in all of these policies that had been in place since the end of World War II. On the scientific support side, Congress is increasingly adding strings to the federal money. For instance, in 2018, Congress passed the Export Control Reform Act that didn't suggest Commerce had to change any of its current regulations, but did say that they were going to have to add new controls on, quote, emerging and foundational technologies. Congress did not define that, but everyone in the work of the field that I work in has expected that that will mean new controls on AI, on biotechnology, autonomous vehicles, quantum computing, additive manufacturing, and certainly in microelectronics. And these new controls are bound to be targeted at major identified adversaries like Russia and China. Last Friday, the Bureau of Industry and Security in the Commerce Department released 140 pages of new export control regulations that are going to really shake the foundations of the American semiconductor industry from one end of the supply chain to the other. In real graphic terms, the BIS has increased the level of export controls on semiconductor supply to China and also semiconductor manufacturing and design equipment and software to China, and has reached out so that they will also now, for the first time, control US personnel from providing support to facilities in China that fabricate integrated circuits at a certain advanced level. So these are unprecedented levels of controls. They're massive. They are really going to change the way the Valley interacts with China, probably in a way that hasn't been felt for decades. And it will probably realign supply chains, not only between the United States and China, but also between Europe and Japan and Korea and China as well, because so many of the other semiconductor production and design facilities are dependent upon enabling technologies from the United States, and the US has indicated that they're going to apply the so-called foreign direct product rule against all of these foreign suppliers. So on the import side, we're also seeing real efforts at policy adjustments to control the flow of goods coming into the United States. We saw the Section 301 tariffs that were added by the Trump administration. We've seen the FCC restrict Chinese-made telecommunications equipment coming into this country. And most recently, we've seen Congress enact the Uyghur Forced Labor Prevention Act, which attaches a rebuttable presumption that any goods made in whole or in part with material sourced from Xinjiang are to be presumed made with forced labor. So that is already having a really sharp effect at ports of entry all over the country. And the Customs and Border Protection Agency has already reported that they are detaining hundreds and hundreds of shipments inbound now. So the takeaway message on the flow of goods is that the US is going to invoke all of these levers to regulate both the inbound and outbound flow of technologies and goods, much as it had done with regard to the Soviet Union during the Cold War.
Nelson, this is a question for you, but also for Anna and Thilo. Have you been surprised about the continuities between what we've seen under the Trump administration and the Biden administration? How many of these policies have either stayed in place or been ramped up to even tighter levels of strictness?
Or Anna, do you want to take a swing first?
I imagine that this will come up in other remarks, but I will just say, you know, in retrospect, not so surprised, but I think that when the administration changed, there was optimism from the business community that, for instance, tariffs might be rolled back, or that other of the restrictive policies that had impeded the U.S. China commercial relationship might be loosened, and the U.S. China bilateral relationship might improve to some degree. But we clearly haven't seen that. The Biden administration has really kind of taken the end of the Trump administration's position that this might be some sort of ideological conflict, and expanded on that. And I think the greatest difference between the Biden administration's policies and the policies of the Trump administration is really the emphasis on multilateral cooperation to try to build up, I guess, greater support for the U.S. position vis-a-vis China in this global competition, as the Biden administration likes to call it. So I think at this point, we shouldn't expect a significant change of the track that we're on, regardless of whether a Republican or Democrat wins the next presidential election. And that's also reflected in Congress, with Democrats and Republicans broadly, in general, supporting a more hawkish and aggressive approach to the relationship with China.
Yeah, and I would only add that it's even not so much a US phenomenon anymore, but you really see the same kind of tendency across governments from across the advanced market economy world, right? Most importantly, perhaps the UK, we see a very dramatic shift in the same direction. So it really isn't just a Trump phenomenon or a US phenomenon, it's an advanced economy development that is taking place at the moment. And I think I would very strongly agree that it is hard to reverse at this point.
I would only add a further comment that I think China itself exacerbated that kind of feeling on the part of Europeans in particular by the way that they have handled the Ukraine situation. I think the European powers were very hopeful that China would take a more constructive and supportive view about integrity of national borders and so forth. And I think China's silence on that has been sort of deafening to a lot of European ears.
Yeah. Well, Nelson, thank you for laying out the kind of dizzying array of policies that have been implemented over the past several years, as you mentioned, on people, trade, and technology. Thilo, you've done such a great job over the years, very carefully assembling these massive databases of investment flows between China and the US, both on the foreign direct investment side and portfolio investment. In fact, much of the media references these databases as sort of the gold standard. So, what's been surprising to me is for a long time, it seemed, despite the kind of deterioration of the economic relationship, the financial flows were continuing apace. But is that now starting to change as Nelson mentioned, some of these policies are really coming to bite, particularly on the semiconductor side, where we see almost sort of a hard decoupling from the US and Chinese semi industries?
Yeah, thanks, Nelson, for the overview on people, tech, and goods. And so looking at the, I guess, fourth dimension here, capital flows. One general comment I think at the outset is that, especially for capital flows, but I think it's true for the other dimensions as well, we shouldn't just be looking at a sort of US policy action and a Chinese response. I think it very much the sort of decoupling impulse that we're seeing is not just the one-sided US dynamic, but it's very much rooted in longstanding Chinese policy, both economic and national security policy. And certainly the other aspect to consider, especially for the last 2 or 3 years, is that we really are living in extraordinary times in terms of the economic fundamentals. Right? We had a global pandemic, we had a very extraordinary monetary policy situation, and now slowly but surely some of the longer standing structural issues in the Chinese economy are bubbling to the surface. So all of these things are really impacting on how some of these flows are playing out, and it's not just US enacted policy. So having said that, just maybe provide a quick overview on the most important capital flows and related policies. I like to divide them into 3 buckets. There's FDI, there's VC and tech investment, and then there's portfolio investment. And maybe starting with FDI, which has for a long time been the bedrock of U.S. China economic integration. FDI has seen a real bonanza since about 2013, 2014, with two-way FDI flows getting all the way up to more than 60 billion at their peak in 2016. Since then, over the past 5 years, we've seen a massive decline in two-way FDI flows. 2020, 2021, we're looking at maybe about 15 billion in both ways, which is a really dramatic compression of that 60 billion flow we've seen since 2016. Biggest driver, again, going back to my initial comment, have been Chinese capital controls and anxiety about Chinese companies and individuals moving money offshore. Certainly, pandemic-related restrictions on physical movement have made a big impact on how these flows have played out in 2020 globally, including between the US and China. And then certainly most recently with the Chinese lockdowns and restrictions on traveling. But of course, US policy has made a big impact starting in 2018 with the reform of CFIUS, the foreign investment screening regime in the US, which has increased scrutiny of especially technology-related Chinese acquisitions and investment. We had a bunch of policies to restrict market access for Chinese companies in the US, especially in the telecom space, critical infrastructure. And we certainly had a few industrial policy initiatives in the US, including the CHIPS Act, that had some provisions in there to discourage certain types of technology investments by US companies in China, which is now probably over the next few weeks and months going to be pushed to the next level, as we are likely going to see an executive order that will impose mandatory notifications and reviews for certain US outbound investments to China. So outlook at the moment, Chinese investment in the US is pretty much dead, except perhaps greenfield. So we're seeing some movement, especially in the EV space, battery space, of Chinese companies trying to follow their customers and getting around tariff barriers, localizing some production in the US and North America overall. But other than that, really not much happening in the FDI space. And a lot of US companies are reconsidering their China footprint at the moment, their China CapEx, in light of both the geopolitical situation, but then certainly also the new reality of a much lower medium to long-term growth outlook for China, the zero COVID policy, which is really driving a lot of the managerial talent out of China at the moment. So those are all factors, and the outlook isn't particularly positive, I would say, for the next few years. Moving on to VC and tech. That's been China's been a big bonanza for U.S. tech investors, including here in Silicon Valley. They made a killing during those boom years, and pretty much, I think Nick mentioned at the outset, pretty much every single Chinese tech unicorn of the early days was supported by American venture capital. Since 2015, Chinese capital has flowed into U.S. Technology startups as well. And again, we got into a I guess, preliminary peak, perhaps, of about 25 billion in two-way flows in about 2018. Then pharma happened, which expanded the scope to venture capital, certain types of venture capital. And since then, flows have declined a little bit, come down, and now we're talking about $5 to $10 billion of two-way flows in 2020, 2021. And I would say regulatory scrutiny is one factor, but what's become increasingly important also for especially big American venture capital firms is reputational risk, right? So being invested in problematic Chinese technology companies like Hikvision is, of course, the poster child that's already out there, but being invested in Chinese deep tech companies that have connections to military products, to human rights violations, to forced labor, to surveillance, has become a real problem. So I would say at the moment, with a few exceptions, most Silicon Valley big venture firms are stepping away from deep tech investments in China. They've moved to consumer-focused tech. Biotech is still happening in a fairly significant way, but I think biotech will be next on the list of policy scrutiny in Washington. And so I think that, along with the overall VC market slowdown, is going to have an impact in the next a year or two on total flows. And the last but not least, just to kind of wrap it up, the one flow that has gotten a lot of attention over the last years, and it's been the only one that's actually been increasing quite a bit over the past 5 years, is portfolio investment. So two-way flows into investment in equities and bonds, especially foreign ownership, US ownership of Chinese onshore securities has increased massively over the past 5 years. I guess like 4 or 5-fold, depending on what kind of data you used. And Chinese policy liberalization has played a big role. There's been a lot more access to onshore Chinese securities, to stock bond connect schemes, a bunch of specifically designated channels for these kind of flows. Chinese securities have been included in global indices, stock and bond indices. And so that's really driven up foreign investment into China. In 2022, that has reversed fairly dramatically because of two headwinds. First, of course, you had a bunch of US policies to discourage US and foreign flows to certain companies, especially military designated companies. There's been the Trump executive order and the Biden executive order, and a bunch of other efforts by mostly the US government to also increase the reputational risk from holding certain Chinese securities. And certainly, and that goes back to my initial comment as well, market conditions have flipped dramatically, right? Especially if you look at the fixed income market. Traditionally, I say before the pandemic, you had about a spread of about 100 basis points for 10-year government bonds. So if you held Chinese government bonds, it was about 100 basis point spread compared to US government bonds of the same maturity. But during the pandemic, that's gone up to about 200 basis points. So that's one reason we saw a lot of this money flowing into China. Over the past 6 months, that has reversed completely, and now the spread is negative 100 basis points. So you're actually getting more money holding a 10-year US government bond than a 10-year Chinese government bond. So a very dramatic change in the yield, and then of course also currency expectations have flipped similarly. So the structural outlook, I think, is still positive in the long run, especially if some of the active flows are going to be scrutinized by policy. That passive exposure is maybe one way to go, but at least for the next year or so, there are some very dark clouds over at the horizon over portfolio investment flows.
Thilo, you mentioned this potential outbound investment screening regime, and Anna and Nelson, please feel free to chime in on this. But Can you give us a sense? So a couple of years ago, we saw CFIUS, which is for inbound investments. That whole regime got strengthened pretty significantly. It's been percolating that there'll be sort of a mirror image for outbound investment. I think it was under discussion in Congress. I think you hinted it may be coming in the form of an executive order. How broad is the scope of this new outbound investment screening regime going to be? And sort of how imminently will investors have to grapple with it?
Anna, you want to start with, you have a better perspective on some of the congressional dynamics, as far as I know, and then I can maybe weigh in on the scope a little bit more.
Sure. I mean, I think that the main thing is that when CFIUS was reformed several years ago, there was talk of including language that would create some sort of outbound investment review mechanism as well. And it was kind of successfully beaten back with arguments that we already have an export control regime. We don't really need the kind of investment restriction or this investment scrutiny. Moreover, it would be time consuming and would likely end up snarling a lot of investments that don't really need to be scrutinized like this. So it would hurt the economy overall and hurt outbound investment overall. There has been a renewal of pressure to come up with some way of exercising closer, I guess, closer examination, closer understanding of outbound US investment flows to China and some other markets, and possibly even putting in place a CFIUS-like process to restrict that outbound investment when there are concerns about national security. At the moment, it seems like some of the strongest proponents of a CFIUS-like mechanism have been persuaded that they don't actually want to go in that direction in Congress because they're not certain that they really want to give the president that much power. So it seems like the majority of people are coalescing around something less than a CFIUS-like mechanism that would simply increase transparency and the ability of the US government to monitor those outbound investment flows, but it could certainly be a step towards something more restrictive.
Yeah, I think that there's probably two possible outcomes at the moment. There's either some efforts on the congressional side to design a framework that's fairly closely connected with export control catalogs and I guess industry definitions, classifications. So to scrutinize investments in areas that are already on those export control lists. And then the other option would be an executive order that would be driven more by sort of White House concerns, and that would probably be more of a list approach that might be slightly broader. And I think one underlying motivation that I've kind of gotten a readout on is that there really is a strong desire to create more transparency as to what kinds of investments are happening in certain areas. So similar to the FIRMA reforms of CFIUS, to really create a notification system. First of all, that companies are mandatory to submit certain investments to whichever agency is going to be in the lead to create that kind of transparency, and then maybe figure out what to do about it. One constraint, and I'm going to end with this, but one constraint certainly is capacity, right? If you look at inbound into the US from China, that's really a fraction of what the deal flow is from the US to China, what is the historical deal flow is. So you're looking at thousands of transactions per year, right? And so from a bureaucratic or implementation perspective, I think there's there are some concerns there as to keeping government capacity workable to really monitor these flows.
Nick, if I could add one more footnote to the really excellent comments made by Thilo and Anna. When Congress reformed the CFIUS system through the Foreign Investment Risk Review and Modernization Act, or FIRMA, they also expanded the jurisdiction to cover real estate transactions. And so real estate transactions are another segment of investments that had grown very substantially over the years. And certainly in our own law firm's CFIUS practice, we've seen a huge increase in the number of deals that were purely real estate deals now going through the CFIUS mill, and some of them being rejected oftentimes because of a proximity factor. And CFIUS now is much more scrutinizing of deals where the real estate being purchased, whether it's an office building or an industrial park, is within a certain radius of a federal installation, like a military base or a dam or a power station or other things like airports, seaports, and that sort of thing. So it's been a mixed bag, but CFIUS has certainly reflected itself in the investment flows, the capital flows in the real estate market, as well as these other segments that Thilo mentioned.
Great. Anna, in your work over the years, you've spent a lot of time talking to both U.S. companies doing business in China and Chinese companies doing business with the U.S. I'm wondering, can you give us a sense of sort of what you're seeing on a more kind of on the ground corporate level as a result of all this conflict and new restrictions we've talked about over the years? Are you seeing U.S. companies actually curtailing new investments into China, shifting operations? And at the same time, are Chinese companies taking actions to sort of reduce their risk to even more sanctions from the U.S.?
Sure. So I think first, just talking about how the geopolitics of the U.S.-China relationship is affecting business, it's worth pointing out and underscoring that friction in the U.S.-China bilateral relationship has become a perennial top issue impacting American companies' business in China. It's something that's cited in AmCham surveys and U.S.-China Business Council surveys and so on. This wasn't the case prior to 2017, but it has consistently been the case since then, and it's getting worse. Conflicting pressures from both the United States and China threaten to put companies in irreconcilable positions, increasing the uncertainty that they face in the business environment. Some corporate concern centers on retribution or punitive action from one government or the other, but companies are also concerned with Chinese business partners and business-to-business customers perceiving them as unreliable because of U.S.-China tensions, and with Chinese consumers associating their brands with unpopular policies promulgated by the U.S. government. In fact, the top impact of U.S.-China tensions reported by roughly half of U.S.-China Business Council members in this year's survey was lost sales due to uncertainty of continued supply. And 1/3 of respondents to the U.S.-China Business Council survey also expressed concerns that Chinese nationalism would negatively affect their reputation and success with consumers in the China market. Many companies report feeling pressured to make political statements. And while there's more perceived pressure coming from the Chinese government and Chinese media, there's also a significant amount that is emanating from the U.S. government and U.S. media. In the American Chamber of Commerce's survey this year of their members, 66% reported perceived pressures from the Chinese government and 32% reported those pressures coming from the US. So are US companies curtailing new investments into China? For the most part, companies are in a wait and see mode. That's partly because of the effects of China's zero COVID policies, which are difficult to separate out from the overall business climate. It's clear that zero COVID is responsible for a great deal of companies' business struggles in China right now. Consumption and services are very sensitive to COVID containment measures. So a rollback of zero COVID policies should be expected to deliver a boost in consumption and help companies to bolster sales. Zero COVID policy isn't expected to continue indefinitely, although the Eurasia Group expects it will not loosen appreciably before the middle of 2023. So pending that policy change, a lot of companies are just sitting tight and hoping for an eventual bounce back, or at least conditions that better reflect the overall long-term business climate and trajectory in China. What nascent decoupling exists right now is mostly limited to high tech and areas of strategic competition and national security, as other panelists have detailed, but selective decoupling is also now basically an inevitability. Moreover, the commonly accepted scope and definition of national security has expanded enormously and encompasses a lot of business relationships that it didn't encompass before. There's still room for engagement in areas outside the scope of strategic competition, but there's also a threat that other China-related policy initiatives could expand decoupling significantly. The Uyghur Forced Labor Prevention Act, for instance, a law that passed in 2020, affects low-tech basic goods and commodities that have almost nothing to do with national security. And in the corporate sector, there's a growing sense that firms should try to diversify some operations away from China, and that the next big incremental investment shouldn't be in China if it doesn't need to be. Still, we're not yet seeing evidence of the US business community preparing for a mass exodus from China. It remains an absolutely critical market for many big US companies, the majority of which would say that these days they're not primarily manufacturing in China for the US or other Western markets, they're really there for the China market. China's growing middle class is already more than twice the size of the entire population of the United States and could grow significantly bigger in the next couple of decades. Moreover, China is the biggest economy in a region that is fast becoming the global driver of economic growth and innovation. So all of this is working to discourage a mass business exodus from China. But optimism about China's market opportunities does continue to slide. While half of US companies with China operations are optimistic or somewhat optimistic about their 5-year outlook right now, that's a pretty big drop from the 3/4 of companies expressing similar optimism at the start of the Trump administration. The majority of US companies that had profitable business in China prior to the onset of the trade war and other bilateral friction, though, remain profitable in China today. And in fact, most continue to see year-on-year increases in their China profitability. And that continued profitability really underscores a core challenge for US companies trying to navigate commercial endeavors in the current geopolitical climate. Namely, China's continued significance as the second largest global economy and a major and growing consumer market means that success in China continues to be an indispensable ingredient for many multinationals' global success. One clear emerging trend is companies seeking ways to separate their US and China business ventures from each other. For many, this means stepping up localization in the China market, i.e. putting more production, services, and research and development in China in service of their China business. This particularly makes sense for companies that really report being in China for China. And that's the majority of US companies with large China operations these days. Supply chain diversification is also a key trend as companies seek to adapt their businesses to cope with ongoing geopolitical frictions. But this doesn't mean companies are necessarily moving supply chains out of China, just that they're creating redundancies elsewhere while maintaining production for the China market in China. Companies making investments in production for the US or other Western markets, which they would previously have made in China, are now far more likely to make those investments in alternative markets, but they're generally doing this without shrinking their China footprint. Some companies are shifting away from certain sensitive industry segments, though, as has been mentioned. I think you wanted me to speak to whether or not China was reducing its reliance on US firms to avoid the risks entailed in doing business with US companies. And in sensitive sectors, yes, for sure. There's definitely something of a trend of Chinese firms reducing reliance on US firms. In the case of Chinese companies sourcing things like advanced semiconductors and related high technologies and goods, they basically have to do this because of mounting US restrictions. There's also a general trend of intensifying commitment by the Chinese government to achieving greater self-sufficiency via policies like dual circulation. That's a strategy that anchors China's future growth and stronger domestic demand and aims to reduce China's external dependencies. And the political dynamics in Washington also, unfortunately, are not getting any easier and are likely to continue to ramp up pressure on both US and Chinese companies to consider ways of disentangling themselves from each other, especially in key competitive sectors like high tech in the years to come.
Well, I know we could keep going for quite a bit on this panel, lots to discuss, but we promised we'd leave some time for Q&A from the audience. So one question that has come in, to paraphrase it a little bit, is, essentially, is there any way to put the relationship back on a more positive trajectory on the economic side of things? And so a question for everyone on the panel: are there any concrete, feasible, and I guess perhaps most importantly, politically realistic steps that the US and China could take to maybe put a floor under the economic relationship?
Okay, so I think the good news is that over the past two Congresses, so the past 4+ years, there's been this enormous increase in legislative proposals from Democrats and Republicans in both chambers of Congress that are China related and that are by and large pretty negative and pretty hawkish. But the maybe somewhat silver lining there is that the more engaged the majority of members of Congress get on these issues, and the more in the weeds they get on these issues, the more they're beginning to grapple with the complexities of trying to pursue policy solutions that will improve US competitiveness vis-a-vis China. They're starting to really try to grapple with the fact that a lot of the seemingly great solutions that they came up with a few years ago would actually undermine US competitiveness, possibly as much as they would protect US technologies, for instance, from China. So I think that it's possible that we'll start to get more nuanced policies moving through Congress and the White House. But the bad news is that I think that trust between the two governments is at a historic low, and I really can't imagine what would arrest that deterioration of trust right now and allow us to get back on a footing that looks anything like pre-2017.
Nelson, Thilo, any thoughts on what, if anything, we can do to push the economic relationship back in a more positive direction?
Well, I like Anna's positive outlook on so much of the situation right now. I like to reflect on the last couple of years. We've all lived through the pandemic. And if you think about how China and the United States engaged or did not engage over a common public health problem, that was killing millions of people. And regardless of nationality, regardless of race, we should have been able to line up together. I mean, that's always invoked, like climate change and other sort of common issues where we should be able to cooperate with one another. And I think, most observers would say that except at an interpersonal or interinstitutional level, the Chinese and the US did not play well together during that crisis, and demonstrated that their mistrust and their misalignment of expectations was so profound that even in the face of something that drastic and that global, they really could not line up together. And that's a very sobering sign of the times.
What else to add? Well, I guess going back, Nelson, to your initial comments, certainly China changing its attitude towards the Russia-Ukraine situation, and other adjustments to foreign policy configurations to demonstrate China as indeed a responsible stakeholder from a US/OECD perspective would be one important step. Having an honest conversation about national security sensitivities and acknowledging each side's interests and concerns, and figure out which areas of economic or commercial exchange are maybe not falling into these sensitivities, right? Sort of creating a common understanding of, we don't need to put tariffs on socks, toys, and underwear, or whatever it is, and really ring fencing those and make sure, okay, we're going to keep those open in sectors that are not sensitive. And then I guess last but not least, really, and that's mostly on Beijing, figuring out a way to arrest or to stop or reverse that sentiment that China is backsliding in terms of its economic system, its economic attitude, and kind of putting China back on a market economy outlook by either coming up with a serious reform agenda that reverses some of the bad decisions that have been made over the past 10 years, or maybe we'll see a financial crisis that'll do the trick and lead to some of these outcomes in a different way. But I think those are maybe three areas that could change the current trajectory, at least at the margin.
One further point illustrating the issue that I had raised earlier about the European perception of where China is today. If you look at the Indo-Pacific and you look at their recent statements relative to North Korea and its missile tests and the continued efforts to develop nuclear weapons, China's comments and public positions have made Japan and South Korea also very nervous and disturbed. I think the perception in many capitals across the ASEAN countries about where China lines up. And that also has ripple effects on other countries like Australia and India. And so it's not a coincidence, and it's not just because the United States is so persuasive that new institutions or institutions such as the Quad have now come back into force and are much more active today because everybody thinks it's in their self-interest across the region to be much more aware and much more thoughtful and much more intentional about their relationships with China at this point. Everybody's on guard.
One thing that hasn't come up yet is this dispute between the SEC and Chinese regulators over audit practices that may end up resulting in all the Chinese companies listed in New York forcing to delist by 2024. I'd love to gauge the temperature of the panel. Is anyone particularly optimistic on this, or is this sort of an olive branch that's destined to fail?
So we're officially somewhat optimistic on it, mainly because there's currently this trial cooperative audit going on between the PCAOB and CSRC in Hong Kong. It's several weeks in. It should wrap up in mid to late December. And I guess from our perspective, number one, there have been a number of steps taken on the Chinese side that are more significant than any steps that CSRC has been willing to take in the past, such as bringing all of the potentially relevant documents to Hong Kong for PCAOB to look at, and including some view-only rules for things that are super sensitive that they can't hand over, that still allow PCAOB inspectors to see the documents. But also, it seems to us that we wouldn't have PCAOB inspectors on the ground and CSRC officials on the ground with them if there wasn't at least a genuine desire to reach some sort of working agreement that would allow for audits to proceed more successfully in the future and allow Chinese companies to remain in compliance with US rules. But we have also seen PCAOB, CSRC efforts like this fail in the past, most notably, I think, in 2015. So I guess, it remains to be seen.
Well, I know we're starting to come up against time. We maybe have time for one or two more questions. One of the questions that's come in from the audience is about the Indo-Pacific economic framework. And I think more generally, just this idea of, can the US diversify away from China? How much is that actually feasible? There seems to be a huge political push behind that, but we love your thoughts, Anna, and others on the panel of kind of how realistic is it for the US to become less dependent on China going forward?
I'll keep my answer very brief because I know that my colleagues will have insightful comments, but the number one problem with the Indo-Pacific economic framework is that it doesn't really have a trade angle. I mean, it says it does, but we don't have trade promotion authority from Congress. We don't have the Biden administration asking for it. We're not negotiating trade deals. And so if we're not offering greater market access to our partners in the region, I'm not sure that we're gonna come away from whatever we're doing with the Indo-Pacific economic framework less dependent on China, or with our partners less dependent on China.
Okay, last question before we wrap things up. Kind of a provocative question, but love to hear everyone's thoughts on it. It is, how badly does China still need access to Western capital, to Western financial markets, to Western venture capital? Has China, for many years has tried to make itself more immune to Western pressure, has tried to develop these kind of indigenous technologies so they're less subject to export controls and things. How well is that working? Does China still need the US, or is it increasingly going on its own path?
Well, maybe to take a shot at that, I mean, it depends on what kind of future you envision. If you have the vision of an autark China that is mostly focused on itself and its companies give up global ambitions, its citizens give up international ambitions, then yeah, certainly you won't need China, foreign capital that much. But if you have the ambition of becoming a global economic superpower with a ultimately convertible currency, financial weight, globally competitive Chinese companies, then you'll have to deal with the reality that Chinese companies and citizens are vastly underinvested globally, right? The global diversification of Chinese savers is tiny compared to what it should be. Chinese companies are also vastly underinvested in the world. They've caught up a little bit over the past decade, but still a long, long way to go if you kind of think about where Japanese companies were at the same time of development. So we'll see if China wants to take that route, we'll see hundreds of billions or trillions of dollars leaving China over the next 10, 15 years under that scenario, and that needs to be offset, right, through inflows. And so from that just kind of macro framework, there's a tremendous need for China to remain attractive to foreign capital, to remain investable, especially for portfolio global institutional investors. And it can't just say, nah, we're good now. There might be some areas, we need to talk about technology investments where the dependency is not as large as it used to be. But certainly from a big picture perspective, China can't just say, yeah, no, thank you, unless it really wants to take that autark future route.
And Nelson, anything you wanted to add?
So this is going to cause me to venture out into some thin ice here, but let me try. One of the supposed advantages of the contact that China has had with the West, and particularly with the United States, since the Great Opening begun under Deng Xiaoping in 1978, has been the gradual introduction of more and more market mechanisms and the rule of law. And many philosophers and political scientists argue that those two things are actually quite interrelated, that you need an independent judiciary, you need the rule of law, you need the reliability in order to create enduring, robust economic systems. And then you need the market mechanisms to send correct signals so that correct choices can be made in terms of allocation of capital and allocation of labor and so forth. And the problem with the current autark model of China trying to divorce itself from the rest of the world, particularly from the United States, is that it forces it back into a non-market model. And economists have already, like Nick Lardy, at the Peterson Institute in Washington, have commented on the rise of the share of GDP that's been attributed to state-owned enterprises in China over the last 10 years, sort of reversing the trend that a larger and larger fraction would eventually flow into private hands. And so therefore, market reforms would sort of come apace along with that. The long-term future of China being able to self-correct and make those adjustments that are necessary to prevent catastrophic mistakes when you have a sort of a command economy and people are making non-market based decisions. History is kind of littered with a lot of those crises that are self-inflicted by governments who are not able to take advantage of those market signals. And that might be one systemic way of thinking about what's happening with the pulling apart.
Anna, do you want to add anything before we wrap up?
No, I think that was a great place to end. I don't have anything to add to that will enrich it. Well,
great. Thank you all three for this fantastic discussion. And Obviously not the most optimistic time for the US and China, but I think Nelson's comments at the end really have a lot of truth to them, that hopefully both sides still recognize the need for one another and that there is some value to be derived from the economic relationship. So we'll see, we'll watch closely. Lots of developments to come in the upcoming weeks. But thank you again for this discussion, and I will turn it back over to Jack.
Well, thanks, Nick, and I'd certainly like to thank Anna, Nelson, Thilo, and yourself for sharing your thoughtful remarks this afternoon. For our audience members, thank you all for tuning in, and we certainly appreciate your feedback and comments on today's events after that. And with that, we look forward to all of you joining us for future events with the CFA Society San Francisco. Take care and stay safe.